This week, the Federal Reserve made its first interest rate cut in 4 years, marking an end to a prolonged cycle of rate hikes that had lasted nearly a decade. The decision to lower rates is seen as a move toward stabilizing the post-pandemic economy. This will improve the material well-being of all Americans, said Joe Brusuelas, chief economist at RSM-US. He emphasized that after 3 years of aggressive policies, the Fed is now transitioning to a more normalized rate environment.
The Fed reduced interest rates by 0.5 percentage point. This decrease will have wide-reaching effects, influencing stock markets, hiring practices, government bonds, mortgages, and other types of loans. According to Michael Madowitz, principal economist at the Roosevelt Institute, this cut is great news for the middle class, signaling that inflation is under control and the economy is on a more sustainable growth path. Lower rates should bring billions more in long-term investments off the sidelines and create thousands of jobs, Madowitz said in comments to the Washington Post.
While the immediate effect on mortgage rates may not be visible, experts predict a gradual decrease over time. Rick Sharga, an expert on housing, noted that lower mortgage rates could lead to increased housing supply. However, some areas may experience short-term price increases as more people compete for limited homes. Constance Hunter, chief economist at the Economist Intelligence Unit, added that many homeowners may now be more willing to sell their homes, given the reduced mortgage rates. This could ease the housing supply issue and benefit potential buyers with friendlier financing costs. While mortgage seekers might benefit from the rate cuts, those dealing with high-interest credit card debt are unlikely to see much relief. Credit card interest rates typically remain high, and companies rarely adjust them following Fed rate cuts. On the other hand, car loans are expected to become more affordable. Lower rates will likely attract more buyers to dealerships, as cars are more readily available and prices are not expected to rise significantly. Savings accounts and investments. Historically, high interest rates had benefited savers, but with the new rate cuts, some might look for alternatives. Many Americans had moved their money into money market accounts to take advantage of higher interest rates. Hunter noted that these funds are now likely to be shifted into stocks, where the lower rates could spur further investments. Joe Brusuelas mentioned that while millennials may benefit from lower borrowing costs, retirees might face challenges. However, retirees who secured high-interest certificates of deposit will continue to benefit from those locked-in rates. Stock market and investor reaction. The stock market's reaction to the rate cut may be subdued, as some investors believe the Fed acted later than expected. Robert Barone, wealth advisor at Farther, stated that this is likely the start of a longer series of rate reductions. The market's response will largely depend on further cuts, and analysts have observed no consistent pattern in stock returns after major hiking cycles. Analysts at Sentiment Trader noted that while rate cuts may be good for Treasury notes and bonds, their effects on the dollar and tech stocks are less predictable. Inflation outlook. The primary goal of the Fed's previous rate hikes was to control inflation. However, with rates now falling, economists don't expect a significant rise in inflation. Some experts, like Barone, even predict mild deflation in certain months over the next year. Though prices aren't expected to return to pre-pandemic levels, they are likely to grow at a slower, more sustainable rate. Specific goods, particularly those affected by external factors like climate change, may still see price increases. Hunter cited rising costs for homeowners insurance and processed foods as examples, driven by climate-related factors. Labor market and employment. One of the key motivations behind the rate cut was concern over a cooling labor market. In August, Fed Chair Jerome Powell said the Fed does not seek further weakening of labor conditions. Recent reports show the unemployment rate has risen to 4.2%, raising alarms that the economy may be softening. If rate cuts lead to more economic activity, businesses could expand and create new jobs. However, the labor market remains complex. Economists Elise Gould and Josh Bivens of the Economic Policy Institute recently highlighted that while the labor market is still strong by historical standards, signs of weakening warrant caution. The rate cut aims to encourage more investment and job creation, but how quickly these effects will be felt remains uncertain.